Good morning, ladies and gentlemen, and welcome to the UTILICO Emerging Markets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Lead Fund Manager Charles Gillings. Good morning, sir.
Good morning, Jake, and thank you very much for the introduction. This is our third presentation, so excited to be delivering it. One thing to note is we are shifting, if you want, emphasis, I think, to give you more insight into why we are excited about the portfolio within UTILICO Emerging Markets. So if I look at UTILICO Emerging Markets and, what are we? We are investors in infrastructure and utility assets. They benefit from long duration mega trends. And I'll come on to the particular mega trends that are driving, if you want, our portfolio. As we say on the right-hand side, our geography is the emerging markets. So we very much focus in on Latin America, Asia, Eastern Europe, Africa, although there tend not to be many investments for us in Africa at this point in time. Our approach, if you want, and process, we are relentless bottom-up investors. What gets us really exciting is finding a good asset, a good management team with very strong growth prospects. We are benchmark agnostic. I think most of us, if we were sat down, couldn't tell you the constituent parts of the benchmark, and it's certainly not something we look at. We report against it because many investors want some reference point, but aside from that, it's not a focus of ours. We are long-term investors, so we can invest through cycles. We have a strong ESG framework, which we apply. And the upshot of all of that is very strong performance. We've outperformed the emerging market over 1, 3, and 5 years. And I think that's, a reflection of the nature of the assets, the growth in the emerging markets, and a very strong bottom-up culture. So, megatrends. Sorry, I think we've got one slide too many. Megatrends. We are so we give unique exposure to emerging market mega trends, and as I said, I'll come on to those. We are invested in real assets. So most of our assets are ports, airports, infrastructure assets, transmission lines, and they have very attractive growth and strong yields, and currently offer compelling valuations. They are predictable, sustainable, and have a growing income, and many of them have, in fact, sort of inbuilt inflationary adjustments and able to price their product upwards. So we're seeing very strong performance at the top line. Experienced management team, I think you've heard us before. We've been an investor since 2005 on the emerging markets, infrastructure and utility assets. Long-term track record, bottom up, as I mentioned, strong performance, 9.4% annualized total return, outperforming the MSCI, as I've noted. Two features just to draw out. We have low beta. I think we're running at about or under 0.8, and we have consistently, and I think that's very attractive because what it means actually is we're good at stock selection, which delivers our outperformance. And I think the other thing to note is our active share of the index is over 98%. So we are not correlated, if you want, with the index. And I think that gives us the strong, if you want, performance over time. What are the mega chains? Energy transition. So things like the move to green energy, and if you want the resiliency in energy supply. Global trade, nearshoring, as you are all aware, there's a lot of nearshoring happening in order to reduce the costs of if you want, transport. But there is also, an increasing trend to supply chain resilience. So looking at supply chains being more diversified. And all of this means that, increasing use of existing infrastructure, generating good returns. Digital infrastructure, 22% of our portfolio, data centers, telecommunications, and businesses that are orientated to, if you want, the transition that is taking place in digital infrastructure. Social infrastructure, very strong drive. Much of our, if you want, target markets don't have, if you want, sewage treatment up at levels that they would want to see. And so governments are actively supporting change and actively supporting businesses that are investing in this space to deliver the outcomes that they want. So handing over to John on energy transition.
Yeah, thanks, Giles. And so the first megatrend we want to talk about was energy transition. Across the world, governments have realized that we can't keep pumping more carbon into the air, and we need to take some serious measures to address this. Within the UK, we're targeting net zero by 2050, but within emerging markets, they've got different timeframes because they're at a different stage of development. China's targeting net zero by 2060, and it's hoping that its emissions peak by 2030. If you take somewhere like Brazil, they're actually a long way on the journey already because over 80% of their energy matrix is from renewables. They have a fantastic hydrology resource, which they use with hydro plants. And then if you take somewhere like India, it has been very reliant on coal, but the government's been doing a great job in investing in renewables like solar, like wind, and they're targeting that over 50% of their energy matrix comes from renewables by 2030. So they're going on that journey as well. And we've also seen in the last year and a half another factor play into this requirement for energy transition, which is energy security. We've seen with the Russian invasion of Ukraine that if you suddenly don't have a gas supply, you could have a real issue during winter. And we've all experienced that with the higher energy prices. And so governments are increasingly looking at energy security as well as the displacement of dirty coal and gas facilities. And in the portfolio, I just wanted to highlight one of the businesses that we're invested in, which is Power Grid India, which is a bit like the national grid of India, except quite a lot larger in terms of network kilometers. It's over 170,000 kilometers of network. And we've been invested in Power Grid India for quite a long time. And the reason being that they're a really good operator. There's a huge amount of investment required. If you think about India wanting to have over half of its energy coming from renewables by 2030, it needs a huge amount of transmission infrastructure to take the energy from the generation plant to where it's being consumed in the cities. And what that means is they're going to have to invest about $50 billion in transmission by 2030. And a company like Power Grid India typically wins about half of the tenders that go into auction. And so it's got a huge investment program. It's got $7.5 billion of project pipeline currently, investing over $1 billion every year. And it's investing in a really nice regulatory framework. They have a committed 15.5% return on equity, and they receive that every year. And so what we've seen from them is some great growth. We've seen earnings growth at sort of 13-14% compound for the last 5 years. The dividend payout's been increased from 50% up to 65%. And what that means is the dividend compound annual growth rate for the last 5 years has been 18%. And this is a company that's still inexpensive. You're trading on 11 times PE. You've got a 6% dividend yield. So it's a great business, and we think there's a huge amount of growth still to come. If we pass on to the
Thank you, John.
Yeah.
So the next mega trend we wanted to discuss with you is digital infrastructure. So this is really led by the explosion in the use of, if you want, technology in terms of cloud-based AI, but all the uses that are driving the global economy, and things like data center innovation allow for significant growth if you can find the right assets, which I believe we have been able to. And the emerging markets are therefore able to serve a growing global customer base. And what do I mean by this? Rather than, if you think back in time, it took you time to connect, to find your customer and transact. Now it can happen in a matter of minutes and seconds. And therefore, the energy that gets released through the digital infrastructure in the emerging markets is giving very, very strong growth to those markets. And we're seeing a number of investments grow significantly. One I wanted to concentrate on the next slide is FPT, which is fourth in our portfolio. This is a Vietnamese listed company. They provide IT services to global multinationals and local Vietnamese institutions. They also own one of the largest fiber broadband and data center providers in Vietnam. And they have Vietnam's largest private education company. They now have over 100,000 students. And what attracts us to them? Leveraging the known Vietnamese skilled IT workforce. Vietnam has a tremendous strength in IT, and I think it's becoming increasingly recognized, and they are able to compete with, if you want, India and the rest of the world when it comes to outsourcing. They have a telecoms network which is benefiting from operational leverage. Particularly interesting, they have a very strong entrepreneurial management team. Two brothers founded this company and continue to be, if you want, the drivers and the leaders. And that, to me, gives me great confidence when I look forward. Today, their client base includes people like Hitachi, Sony, and Airbus. And the most interesting thing for me is they targeted 20% growth rate, and they outlined that to us I think it was 5 years ago. They've delivered ever since. And if I look at the first 5 months of this year, their revenues were up 23%, and their earnings were up 22%. But even more pleasingly was, if you looked at every metric, be it the number of clients that they're onboarding, those are expanding. If you look at the number of students that they're onboarding, they're expanding. So very strong growth underpins. And I have firm belief that they will be able to achieve their ambition over the next 5 years. So a very exciting investment. Jax?
Yeah. Okay, so the next mega trend that we've also sort of identified that is one of the factors that is driving the portfolio at the moment is global trade. Global trade is providing us with ample opportunities, especially within the transportation and logistics sectors. Emerging markets is also becoming a much more and more important player in global trade. And that has been driven by the increase in GDP per capita, which is obviously driving sort of consumption and the growth of the middle class, and within the trading sector, it's driving sort of imports and exports, and improvements in productivities as well is also flowing through. Such that by about 2050, emerging markets' share of global GDP is expected to actually exceed that of developed markets, which is just showing you the importance of the global trade within the emerging markets. What I think that is really interesting over the last 3 to 5 years, though, we've seen a sort of a slight shift in the way in which global trade is happening. Some of the factors there are numerous factors that have caused this, but one of which has been COVID-19. COVID-19 caused massive global supply chain disruption, a big shock. A lot of companies got caught short, as a number of companies only had manufacturing hubs in one location. So now what's happening is you're seeing a number of companies looking at having the sort of what we call the C+1, China plus one model, i.e. having somewhere else placed apart from just, say, China, as a location in which they manufacture. And Vietnam, for example, India, Mexico are all countries in which are massively benefiting from this. Also, what we're seeing at the moment is the increasing geopolitical pressures. And this is also having a huge effect or an impact on the way in which trade is flowing globally now. Companies are looking to see how they can actually nearshore, I suppose, some of their manufacturing to make sure they have better control over it, to make sure it's closer to the final consumer. And again, one of the countries in which has been benefiting massively from this is Mexico. At the moment, Mexico is now the largest exporter of goods to the US. It's overtaken China in the first quarter this year, which something, say, 2 or 3 years ago, I wouldn't have thought necessarily would happen. But that is part of the sort of geopolitical pressures that we are currently seeing. So how are we playing that in the portfolio? Well, if you look at our number 2 holding in the portfolio, International Container Terminal Services, you can see this is a great way in which we're playing the sort of the mega trend of global trade. ITT is listed on the Philippine Stock Exchange. It has a market cap of approximately 7 billion. And it currently operates around 30 ports, container ports in 20 countries, primarily in emerging markets. The ports all have long-term concessions, which means that we're able to capture the economic growth of the emerging markets and the increasing consumption, as I mentioned earlier. That's all flowing through nicely. But also the company has very high operational leverage. It has a very high fixed cost base. So that as volumes are increasing, what we're seeing, therefore, is, as long as those fixed costs are covered, every additional container, i.e. box that they can handle with is flowing through to sort of the bottom line. And the key financials here show this. Is we know that over the last 5 years, volumes have increased about 25%, but EBITDA has increased by about just under 90%. And also there's a very solid and strong management team in place, which is again driving operational efficiencies. And EBITDA margin of result has increased from 54% to over 62%. We've held this stock for a number of years. So we've managed to benefit from the share price performance, which has been roughly about a 19% CAGR over the last 5 years. But as John said with his companies, this company is still relatively quite cheap. It's trading at 7 times EV EBITDA with a nice yield of 3 to 4%. And is benefiting, like we said, from the drivers of global trade flowing through. So we still believe there's a long way to go for this company yet.
Thanks, Jax. And then the final mega trend we want to talk about was social infrastructure, it's describing all those services which give you a better quality of life. Now, here in the Western world, we're used to having an electricity connection, fresh water, sewage services, waste collection, education and healthcare. And all these social services are things that people demand as they move up into the middle class. And across emerging markets, you're seeing people move from the rural areas into cities. We're seeing this urbanization trend. And what that means is that's putting more and more pressure on governments to provide social infrastructure such that those cities can keep growing and the populations can keep being productive. And so when we're looking at companies within the portfolio that fit this profile, we're looking at waste and water companies. We're looking at airports. If you take a place like Mexico, it's a very large country. So if you're visiting family from one side of to the other of the country, you'd be taking very long bus journeys, or there's a lot of internal flights. And it's the same with Brazil, a lot of internal flights as well. And then you've got electricity distribution. So we have Umeme in the top 30, which is a Ugandan distribution company. And there it's about connecting households to electricity. These households, which were reliant on kerosene lamps previously, now can be on the electricity grid. And that has a huge positive social impact for families and for their economic productivity. And we wanted to highlight, again, one of the companies in our top 10, which is Horizon. And this is a Brazilian waste and water management company. They have several landfills across Brazil, and they only listed a couple of years ago, and they were relatively small, but we did a lot of work on them, and we got really excited by the opportunity because the waste industry in Brazil is very fragmented. There's hundreds and hundreds of small players, but there's also a lot of illegal players. So a lot of municipalities are dumping waste in fields, and that's a terrible thing for the environment because all the greenhouse gases escape straight into the air as the rubbish decomposes. All the leachate, which is the very toxic watery waste, sludge waste that comes out of the landfill, that will go into the water table and poison the water table. And so the government's put in place some legislation which said we have to shut down these illegal landfills and everything has to go to properly regulated sites. So you've got a huge opportunity for a company like Horizon because they have the capital, they have the expertise and the knowledge to run these sites securely, safely, and to the appropriate legislation levels. So we invested at IPO. They have grown phenomenally quickly. I mean, you can see in the chart there, profitability growth in the last year, 66% growth in EBITDA. That's through acquisition, but they still only have about 10% market share. And we see this as a business which will keep growing. It will keep acquiring. Last year, they managed 8 million tons of waste. And it's the kind of operation that in the next 5 years could easily double or more. So we're very excited by the opportunity that they present. And for us, it's probably one which will be in our portfolio for a few years yet to come. And Charles, if you want to move on to some of the other aspects of UEM.
Oh, well, thank you, John and Jack. So I hope you all can see, if you want the drivers if you want the mega trends which are underpinning the portfolio and why we're excited about it. But just some aspects we wanted to share with you. Inflation, a number of our investments, as John and Jack have said, benefit from inflation adjustments. And these are adjustments that they are able to pass on and do pass on. I've always been amazed at the strength with which management teams have stood up and if you want, put through increases so that they get the correct inflationary adjustments. They're very strong businesses in their local markets, and therefore they're able to pass through price increases. And the one thing I would say, in the last 12 months, most of our investee companies have seen unit growth, i.e., the number of containers at a shipping port, but they've also seen pricing growth, and that's translated into very strong top line growth, and that's very exciting to see. Interest rates, it's true that the sector does have leverage, but in the emerging markets, leverage hasn't been a key fundamental driver. A number of them take it on in order to produce some efficiencies, but by and large, I think our portfolio, as it says here, is under-geared. It's 2.2 times geared. And I think the other thing to note is most of our investments are listed. Most of them are operational. It means they're up and running, generating a cash flow. And because of that, they can certainly more than meet the debt demands that they have taken on. FX, we've looked at matching FX at a portfolio level. It's quite difficult to do. an underlying investee level, most of them are, if you want, operating in the local market, and therefore FX is not a big concern for them. Energy prices have offered outsized returns over the recent 12 months. Obviously, as you know, energy has been quite volatile. A number of them have been able to capture that price differential into their business models, and so we're not seeing undue stress within the investments that we have. Geopolitical tension, this is probably something that keeps us, everyone as investment managers, focused, and it goes from, if you want, the China-US friction through to the terrible war in Ukraine, but also through to, if you want, elections in Turkey, elections in Brazil. I think the upshot of all of this is that people are looking at resilience in their supply chains, and they are also looking at, if you want, the cost of supply, and therefore, if you want, nearshoring, bringing it closer to, if you want, the production to the consumer. And as Jack said, you know, we're seeing a real uptick in nearshoring in Mexico. And if you look at diversity in supply chains, we are seeing, if you want, Vietnam benefit from marginal investment decisions. A lot of corporates are not withdrawing from China, but are certainly taking the decision to put their next, you know, big infrastructure asset into Vietnam and other markets. And all of this, I think, gives a lot of strength to our portfolio. So very excited about the characteristics of, if you want, the portfolio and the mega trends that are driving it. And to talk about valuation, Jax is going to lead us through this.
Yeah, so Charles has obviously highlighted how resilient our portfolios are to the sort of current macro and geopolitical pressures that we're witnessing. But what I wanted to sort of highlight here on this slide very much is, you know, you have the valuations at the moment, and valuations are very much at multi-year lows. And we believe that UEM's portfolio continues to be incredibly attractively, well, is attractively valued at the moment. If I take a step back and I look at emerging markets as a whole, emerging markets at the moment are very cheap on an absolute and relative terms. If you look at the bottom slide on the bottom left-hand side, you can see that emerging markets over the last 25 years have only been cheaper 8% of the time. Currently, they're trading around 10.7 times PE, where the average over the last 25 years has been around 16.3 times PE. So that differential there is showing how cheap emerging markets have been to historical levels. On the flip side, if we then look at, say, the developed market world, and we look at, say, the S&P 500, again, you know, they're trading at sort of extremely high multiples. Developed markets are comparatively still relatively very expensive. The S&P 500 over the last 43 years has traded on average of 21.7 times compared to where it's trading at the moment, which is about 26.8 times. Again, showing you how expensive developed markets are compared to EM, and showing you, I suppose, what such a great opportunity emerging markets are. But in particular, what I wanted to highlight was, if you look at UEM's portfolio, we believe that we are attractively valued. We're trading currently at about 11 times forward PE. And if you compare that to the MSCI Emerging Markets Index, that is 11.6 times. We are cheaper. We also offer a yield, or a dividend yield, of 3.8% relative to the MSCI Emerging Market Index of 3.4%. And on top of that, frustratingly, we do have a discount of 15%. So we've got the discount. We are cheaper than the MSCI Emerging Markets Index. We believe, as Charles will come on to in a minute, that we do have a sector-leading performance. We're offering a higher dividend yield than our sector peers at 3.8%. As Charles mentioned earlier, we have low volatility. We have a beta of less than 0.8 times. So all these factors together, we believe, provide an incredibly compelling entry point for new and existing investors. Charles, I don't know if you want to go on, John, do you want to talk about now the investment approach?
Yeah, so we just want to give you a quick overview of the way that we approach investments and the process we go through. And we've given you an image here, which gives you an idea of the process we work through up to the top, where it actually makes it into the portfolio. But if you're starting off with idea generation, we have a broad team. We have people in Brazil and in other countries which are feeding in information to us. We are tapped into all the broking network, and we have a lot of direct relationships with all the companies as well. We travel quite a lot. We get out there, we see the managers of the companies. We get out and see the actual assets themselves. So we're not just trying to meet the chief exec and the CFO. We're trying to meet the guys who are actually delivering the operational side to figure out if this is a good team and a well-managed team, and these are good assets inherently. So we screen probably over 1,000 companies. We are often one of the first people to be called if there's a new IPO in the infrastructure space in emerging markets, because people know that we are specialists in this area, and we will often get sense checked ahead of IPOs as to whether we'd find it interesting and what problems we'd highlight, and the kind of valuations, whether they make sense to us. And as we go through that screening process, we'll narrow down in onto a few companies where we think, okay, there's a really exciting prospects from the company, from the regulatory environment, from the industry, from any particular changes in sort of political backdrop. And we will then model out the companies ourselves. So we have our own financial models, and we will then do a valuation based off of that. And we're typically looking for double-digit IRRs. And if we getting through that hurdle, we will then do the full ESG screening, which Jax will talk to in the next slide. And if we pass through all those hurdles, we go, great, we've got a good opportunity. We want to put it in the portfolio. So what are we going to sell? Because we're a closed-end fund. We have a certain amount of capital to invest. And so we have a discipline of, okay, this is a really good opportunity, but what is it giving us that we haven't got already? So it can be diversification in terms of country, in terms of sector. And so we would typically look to be moving out of a position or reducing a position to give room for something new. So there's a good investment discipline around that. And then the discipline on the selling side is, we have constant screening of our existing investments. We have certain levels that we look at to be triggering exits or reductions. And these will move, because if you have quarterly results coming out, annual results, and we see that there's been financial progress such that the valuations and the share prices haven't actually kept up, well, we may be more comfortable hanging in for longer, because in a Buffett style way, the best investment is one you don't have to sell. So Jax, do you want to talk through the ESG side of things?
Yeah, if I just I'll just touch on the ESG investment approach that we have. As John said, look, ESG is very much embedded in our investment process. We are sector specialists within the utility and infrastructure space, so we like to think we are, we know all the sort of the key risks that may arise within those sectors. We do in-depth analysis on every single investment we make, to ensure that we fully understand it, and then we integrate that into our sort of financial modelling and into our sort of investment reviews. So it is built in. I would add here, though, we are not an ESG fund. We are not solely investing for ESG purposes. However, we do integrate ESG, and it does form an integrated part of our decision making and ongoing monitoring process. We do find that sometimes, obviously, we are playing in emerging markets, so sometimes ESG can be maybe a little bit challenging, say. But so we're aware we have sort of gaps in the information that we need to make a full assessment. We will engage with companies. Companies also which don't rate that highly on our ESG scoring basis, we will actually challenge them. We will try and help them as well, and we'll try and encourage them to try and improve their ESG positioning. We believe, though, for ESG within emerging markets is very much a journey. If a company is not scoring, say, super high at the moment, but it's got a process in place in which it's developing, I suppose, or improving its ESG footprint, that is something that we will also take on board. If we look at just on the right-hand side of this slide here, that is just sort of giving us a sort of a flavour of sort of the analysis that we do within as part of our ESG process. The percentage of UEM or top 30 companies within UEM at the moment that do have sort of an ESG sustainability report, 75% of our top 30 do disclose that, and 64% of the top 30 also report, scope 1 or 2 emissions. So that's just to give you a bit of a colour of, sort of the companies in which we're sort of dealing with. But I think for me personally, what I really want to take away from this presentation today, and we've run through the investment approach, and you understand now that we're very much bottom up, sort of benchmark agnostic. As Charles mentioned, we've got an active share over 98%. Is what does the portfolio actually look like? We are highly active managers of this portfolio, and we believe completely that we are offering a very unique and diversified investment opportunity, playing the mega trends that we've already identified. If you compare us, say, to the MSCI Emerging Markets Index, which has 22% of the index in financials, we don't invest in that. That's not our bread and butter. It's in utilities and infrastructure. We have no consumer discretionary. We have no materials. We have electricity at 19% in our portfolio. That's the biggest position in the sort of sector that we have in the portfolio. And that's playing that sort of energy transmission megatrend that we're witnessing. Ports and logistics is playing on that global trade theme that we've also discussed at 17.5%. And I could go on, data services with digital infra at 12.2%. And because we're very much bottom up, our geographical split and the sector split is very much an outcome, I suppose, of what we're doing. And if we look geographically again, China as a percentage of the MSCI Emerging Markets Index stands at 29% exposure. We only have 15%. We're not interested in the Alibabas, the Tencents, the Taiwan semiconductors. That's not what we're interested in. And we're much more interested in actually what is the investment opportunity that we can see. Just to clarify there also, if you look at the geographical split, yes, macro and political, just to clarify, we are very bottom up, but macro and political considerations do come into play. If the risk is too high, obviously we won't venture into a sort of a geographical location where we believe that, the risk is just simply too high. So, but what a UEM investor once said to us, and I thought it was fantastic, the feedback we got, and I think that totally sums up what UEM is about. We're an attractive alternative way to gain exposure to the economic growth of emerging markets via a more resilient, less volatile return profile of infrastructure and utility-rated investments. So to see how that all pans out, I'll let Charles now run through our share price performance and how we've performed.
I agree 100%. We are, if you want, undervalued, and I agree 100% that we have a resilient growth portfolio. What's that translate into? You can see our NAV performance here has been strong over time. And I think if I sit here today looking out over the next 5 years, there's no reason not to believe this trend should continue. You can see we've outperformed the MSCI 1 month, 3 months, 1 year, 3 years, 5 years, and since inception. And that performance has been a composite. It's been both a return on capital, but also a strong dividend performance. So I'm particularly pleased about it. I've seen in the questions somebody's asked how have we performed against the peer group. If I'm really honest, we tend not to look at the peer group. I think we offer, if you want a lower volatility, we offer a higher real yield for the performance we're achieving of 9.4%. But I think if you went and looked at the competition, I think you'd find us standing at the top and confident about our future. If I look at dividends, a couple of points to note. As we've said, most of our companies are operational. What's that mean? They own an airport, or they own a port, or they own a transmission line, or they own a data center. So we can, if you want, look through their cash flows and determine with reasonable confidence the outlook. But one of the outcomes of these businesses is they're able to pay, if you want, dividends to us as shareholders. So over time, we have grown our dividends. I'm very pleased to sort of note that even through COVID, our earnings covered our dividends, and I think that's something that we are, proud of and confident of. We get asked how much of the portfolio pays a dividend. 78% at the moment pay a dividend. The balance are companies that are investing for the future and have very strong growth prospects, and we're comfortable that at this particular point in their cycle, we prefer they invested for growth rather than dividend. The board is conscious, and so are we as investment managers, that a lot of our shareholder base places value on the dividend. So certainly it's something that we do, take into consideration. And as John said, when we're looking at an investment, we will tend to, if we find a compelling investment, to go into the portfolio, and we've got a choice between two. We'll probably take, and they give us equal outcomes, we'll probably take the one that gives us diversity, but also take the one that gives us a higher a dividend. Why? We just think that the discipline of cash flow and dividends is something that adds strength to our conviction. So we've been able to increase the dividends over time and pay them quarterly. In terms of trying to sum it up, and Jax, you did a fantastic job of summing up why UEM. I think if you just look at three buckets, the portfolio, as I've stressed, cash generative, operational assets, compelling valuations, underlined by Jax. These are well outside normal levels. And if I give you, for instance, something like ICT, I think over 18 months, their share price has gone sideways, but their performance has been very strong. And we've got every reason to believe it will continue. So the valuations that are within the portfolio today are certainly, in our eyes, compelling. Resilient through economic cycles. I think if you looked at, our portfolio performance over time in the earlier graph, you will see that while we certainly can't sidestep market movements and dislocations, we quickly correct and continue on an upward trend, and I think that just reflects resilience. One of the real opportunities we have, though, is we can afford to look through the current government or the current market cycles and buy assets very often at compelling valuations and sit and wait for those valuations to come through into our portfolio. So I think the benefit of being a long investor is very true within our portfolio. Differentiated from the MSCI Emerging Market Index, I think Jax has eloquently put that strongly across. And what are we benefiting from? As we've said, energy transition, digital, global trade, and social infra. All of these, there are decades of investment to go in the assets that we find compelling. So if you want, there's a very strong underpin, both driven from governments, but also, the markets in each geographical locations. Performance, the long-term performance has been strong, and we're pleased about that. Covered in growing dividend, as I've said, high active share, low beta, and ultimately, I think you're benefiting from a very strong specialist investment team who understand, if you want, both the nuances, but also the raw growth that's available in the emerging markets. So, over 17 years performance, and we delivered 9.25% with a rising dividend yield. So very excited about where we are and where we're going. And thank you for listening to us. I think there are a number of questions. I I'm not sure how we should go through them, but if we start top right.
Do you want me to lead the questions, Charles?
Yep.
That's fine. Okay, so the first question that we've got is we've highlighted some interesting companies with very strong growth and performance. What experience have we had? What experience have you had of bids of portfolio companies, and would you expect this to change in the coming years? And if so, where would the bids be coming from?
So I think we've had some experience of bids in the portfolio, and certainly from time to time you'd expect that in a portfolio of this nature. You would expect bids to come through. What I would say is we've never invested for, if you want an outcome of a bid. We invest because we love the compelling opportunity that exists as the current management, current asset, current outlook. Bids come along, and if they're sensible, of course, we'll support them.
Okay. Thanks, Charles. And the next question we've got, and I'll just quickly take this one. It's also, where does ESG sit in your investment decision process? Hopefully, John and I sort of answered some of that question as we went through the presentation, but essentially ESG is a very fundamental part of the investment approach. It's ingrained in the investment process, and it does help us sort of flag very sort of if there are any risks or anything, but also help us to understand the company in a better light. But are there also companies that you will simply not invest in? I think we won't invest in, for instance, like companies or tobacco companies, companies that make weapons and those kind of companies. They are not companies in which we're investing. But I think I would just like to say ESG, again, I will stress, is not our fundamental driver of why we make an investment, but it does is a key part of our investment process. Another question that we have is...
Can I just add there, sorry, Jax?
Go on.
Sorry, Jax, can I just add there, on the ESG side of things, you said areas you wouldn't invest in. There are obviously a lot of listed thermal coal-fired companies in emerging markets. And we haven't been invested in those companies for several years because our concern is on the duration of those assets, because they're clearly going to get mothballed and become stranded assets as renewables takes over. So you've got an investment decision there. And the ones that we have supported, where we have had coal-fired assets, they've had to have a very clear plan on transitioning to green energy. And in the top 30, you'd see ECL Engie Chile, which has been on that transition path, going mainly from thermal to being 100% renewable by 2025. And so we're supportive of those kind of journeys.
Yeah, I mean, as I'll add to John's point there, we're very much about the ESG journey of which the company is undertaking, whereas rather than the ESG position that it sits today, we'll try and help them to improve that ESG positioning which they currently have. Another question we have is, from a capital allocation perspective, is your preference to support existing investment through follow-ons, or look at new opportunities, or increase share buybacks? I might leave that one to Charles.
I think our fundamental starting position is support the portfolio. You've heard that we have a number of compelling investments, and if they come along, or if the share price weakens, and from time to time we do see share prices weaken because market sentiment changes, we will, if you want top up, we will buy more and support our existing investments. We do look at IPOs, and as you would all know, there's currently quite a big opportunity in Romania that we are looking at. We do look at IPOs from time to time. We do them, but we're pretty determined on achieving an entry price that is compelling for us as investors. We're not looking to, in my language, flip an asset over a day, a week, or a month. We're looking over 3 to 5 years. And so IPOs do feature, but are not the driving force. Buybacks, I think to the extent that the market is currently offering us nearly 15% discount, we are happy to buy back as an investment decision. If we like the portfolio, then we must like buying back the shares. I think the position we want to reach is one where the discount is much narrower, and if you want buybacks are therefore not something that we would actively undertake. So I think that gives you the answer. The existing portfolio is the key focus of most of our effort and most of our dialogue.
Okay, thanks, Charles. Another question that we've got, sort of slightly related to ESG, is can you talk about how you monitor and manage the governance of portfolio companies? How has the governance changed over time? I can give that a bit of a go. I mean, the governance is very important to us. I mean, we're investing in emerging markets companies. The governance is key for a company. With strong governance, we typically tend to see strong performance of the investee companies. Not always, but there's a very strong correlation. But what we have seen, I suppose, within emerging markets, it's how governance has improved. Emerging markets now, they get the importance of governance. They get the importance of having separate CEOs and chairmen, of having independent boards. So there has been a big improvement within that. I mean, many of my stocks have definitely improved on their governance over the years. I don't know, John, if you want to add anything within your sector of any examples that you've got there for governance.
On the governance side, it's company by company and country by country. But I would definitely accentuate that in the last 3 years, we've seen a huge step up in the recognition of needing better governance and accepting greater independence on boards, those kind of things. And that's something we've been engaged with the boards for quite a long time.
Yeah. And I will add on that, actually, within sort of, some of the companies, even, we are very active with the management teams. And if there is something on the governance side that we don't agree with, i.e., I don't know, the board is not independent, we will actively vote against that. So the companies are aware, and we are sending them a very clear signal of how we want them to improve the governance if needs be. One of the questions that we've also got come in is several closed-end funds have been penalised for their unquoted exposure. What is UEM's strategy and position with unquoted? John, do you want to go into what our unquoted exposure is first?
Yeah. So on unquoted, we have a touch over 10% unquoted within UEM. We have in the company articles a 10% limit. That has been an outcome of some successful investments, which are made at a much smaller amount. And directionally, we're not looking to invest in more unquoted. We're looking at reducing our exposure, and there are a couple of transactions which are ongoing, which should bring that down over the next 12 months. Notwithstanding, there could be other revaluations which could affect that percentage. But I think the takeaway you should get is that we're not looking to actively invest in more unlisteds. Our strong preference is the listed space, and I think over time you'll see that more and more.
Thanks, John. Another question that we have is, please, can you clarify the company's exposure to China and Hong Kong? How much is China and how many investments does it represent? I should briefly start, and then John, I'll hand over to you probably. If you look at sort of, I think, page 16, where we sort of speak about the geographical splits, I mean, China currently makes up 15% of the portfolio. Again, as we're bottom up, that's very much an outcome of investment decisions that we've made. And on my side, on the infrastructure side, I mean, I have got one investment within the top 30 that is in China, and that is Shanghai International Airport. You may ask why we invested in that. That is very much a sort of play on the reopening of China. The sort of the belief that passenger travel will come back post-COVID, and international travel will start back. So we bought into that stock just as we were coming out of or China was coming out of COVID, just before they did the U-turn on their COVID-19 policy. And we're now sort of slowly seeing a pickup there of passenger numbers coming through, and hopefully slowly over time, as that starts picking up, we will see an improvements in the share price performance of that company. John, I don't know if you want to talk a bit about your exposure.
Yeah, so the other exposures within the top 30, you've got some Chinese gas distribution companies. You have Datang Renewables, which is a wind farm operator in onshore China. And then you have one of the unlisteds, which is UEM Hong Kong, which is an onshore solar and wind farm developer, which is already in realization stage. And so, as I mentioned, that we were looking to be bringing down that unlisted percentages. They've already agreed to sell that portfolio to Semcor. And so that's in a return of cash phase. And so that's one of the transactions which is ongoing and should help bring that percentage down. I just note in the questions that Adrian's asking about, you think you'll return to company article obligations within the next 12 months. We can't say exactly what's going to happen next 12 months. The 10% limit is after 10%, we cannot invest more in unlisteds. If they are extremely successful and that 10% goes to 15% as a result of valuation gains, and then there's not a lot we can do about that side of things. What we can say is that we are looking to realize the positions where possible, and we are looking to be back down below 10%.
Brilliant. Thanks, John. So the only other, Charles, I don't know if you want to talk about sort of some of the tech positions that we've got in China and Hong Kong at the moment.
So in China, we're invested in a data center, which is doing extraordinarily well. And if you look at the outlook for that company, it's very strong. We're investors in a telecommunications business in Hong Kong, which is Hong Kong, Macau centric, and certainly is benefiting from, if you want, the telecoms traffic, data traffic in that market. They've converted a lot of their premises to data centers themselves, and if you want, they're fully utilized. So seeing a strong footprint. I think, one thing to sort of emphasize is, while we might look at Hong Kong and say it's challenging in terms of outlook and its relationship with China, within these markets, and this is true of everywhere, there are businesses that are benefiting from these megatrends, and our telecoms business in in Hong Kong is absolutely benefiting from those megatrends, and I don't see what will disrupt it.
Brilliant. Thank you, Charles. Sort of one question off, but I think, Charles, I think you've already partially answered it, is how do you perform against your peers, and what would you say differentiates you?
I think I probably answered it. We perform strongly against our peers, especially over the longer duration. I think, like everything, if there's an uptick in some of sectors of the market, some of the peer group, depending on weightings, etc., might outperform 1 month, 3 months, 6 months. But over the medium to longer term, we've certainly outperformed. And I'll go back to it. We are, a low beta, i.e. a low volatility performer with a good dividend yield. And I think that combination differentiates us very strongly. Obviously, the key feature, despite, we talk about megatrends and things, is our assets are infrastructure and utility. I think on that front, we're almost unique. We're certainly unique in the UK listed market in terms of an infrastructure and utility asset base within the emerging markets.
Brilliant. Thanks, Charles. That's the last question.
Charles, John, Jacqueline, if I may just jump back in there, and thank you very much indeed for your presentation and for being so generous of your time and addressing all of those questions that came in from investors today. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the Investor Meet Company platform. But Charles, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
I hope you can understand and share our excitement about the opportunity within the emerging markets and in infrastructure and utility, and the growth trends that are being driven by the mega trends, and take away that we firmly believe we have a growth outlook portfolio with low volatility, good yield, and strong mega trends, which will continue to give us opportunities for the next decade. The other thing I would sort of direct you is, do go look at our website, join in on LinkedIn. We're trying to communicate, I think, at a much more faster pace, and it'll enable you to keep up with, if you want, with developments, but also get a sort of deeper insight into some of our investments as we travel and meet the management teams and see the assets. Finally, thank you for your time today. Thank you.
Thank you.
Charles, that's great. And thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of UTILICO Emerging Markets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.